Hi trader, this is Chris from Elite Currency with another video, part 14 on the Fibonacci series. This time around we're going to take a look at the mental game, the bounce or break basically at each of these Fibonacci levels, and that's always a very fascinating battle. Before we take a look at the topic though, be aware that trading for exchange is considered high risk and may not be suitable for everyone. Please pause the video to read the entire disclaimer, and by continuing watching this webinar or video you agree with this disclaimer and you're aware of the risks involved. The video is only intended as informational and educational purposes. Alright, I hope you know and hope you already joined, but just in case you didn't, we got an FX trading festival. It's great, cool topics, lots of great content, lots of free indicators as well, and ebooks, and you name it. So if you join, you get a lot of value for that. Just write an email to info@elitecurrency.com to join the webinar festival about Forex, of course. So today, the focus, well, we're going to take a look at basically the mental game when Fib trading, because when price is retracing, we don't know exactly which Fib will be used. It could be each and every Fib, or it could be occasional Fib. It could be the 23.6, and that's it. It could be the 23.6 and the 30.8.2, and that's it. Or it could go through the 38.2 Fib and eventually bounce to the 61.8. We really don't know. I'm going to talk about a bit more about stats and statistics in a while, but we really 100% for sure we never know. So there's always that kind of doubt, like, okay, is price going to respect this Fib? So from that point of view, it's our job to make an estimate about each Fibonacci level and judge which one has the best probability of moving to target. Now, how do I complete that analysis basically? Well, I look at various things. I look at chart confluence, for instance. I look at the chance of price respecting that Fib, and I also look at which Fib level. So we're going to take a look at all these three things in just a second. All right, starting with the chart confluence. First of all, we talked about that actually in part 12, and well, it's just a very good thing because if there's, for instance, a target and a retracement at the same spot, great. All right, we have confluence. There's a better chance that price is going to bounce there. I think that's clear. Just take a look at that video, part 12, if you need more info on that. Now, what else makes us have a better idea about which Fib will get respected? Now, the chance of respect varies. All right. In my kind of experience, I use a rule of thumb that says 2 out of 3 Fib levels will be respected, and 1 out of 3 will not be used when looking at one specific time frame. Now, ultimately, even if a Fib level has not received a reaction from the market on, for instance, a daily chart, it could have been respected on the lower time frame, like an hourly, but you don't see that on the daily. So I'm talking about when I look at one time frame, what is the chance that price visually stops at that Fib? And 2 out of 3 times it happens, and the other 1 out of 3 times it doesn't, and it probably will on the lower time frame, as already explained. So the main point is that not all Fib levels will be respected. Some will break, basically, but most will hold, because we're talking about 67%, when, of course, using a proper swing. So that's important to know. Then, also, there's just a general kind of chance of price bouncing at a Fib. And I've read a study that showed that deeper Fibs are indeed used more often than shallower ones. Don't have the source, unfortunately, but I did read that. It explained that about, at the top of my head, 25% of the time, price reverts back to the 23.6 or the 38.2 Fib when it's trending, of course. But 20% of the time, price reverts back to the 50 Fib. About 20% of the time, it goes back to the 61.8 Fib. And the remainder, which is 35% of the time, it goes back to the 78.6 or the 88.6 Fib. Right? So once again, those numbers, 25% for the shallower Fibs, the 23.6, 38.2, the 50 and the 61.8, each 20%, so total 40. And then for the last two, 35%. So that's the chance the price will get there. In this case, it went back all the way to the 88.6 Fib. So as price goes lower and lower, right, or higher and higher, goes back to these Fibs, the chances of it bouncing or continuing, of course. That's always that game. Will it continue, bounce, or break? But now we have some percentages to have an idea about that. So what are the pros and cons of trading shallow fibs? Now, of course, in general, you could trade all fibs. You could trade all 6 fibs and kind of scale in. And we'll talk about scaling in, scaling out at one point or another, at one point in time. But of course, that I have to make sure that the risk, first of all, is not too large. It has to maintain and be in the risk that you have stipulated for yourself, and that's not easy with 6 entries. That's not something that I would recommend. I mean, you could split perhaps the entry in 2 fibs, but then of course you run the risk of missing one and catching only half of it. So personally, I like to just focus on 1 fib, but splitting in 2 or 3 is possible. We'll talk about that later on in a different video of scaling in and scaling out. In any case, let's talk about the pros and cons of shallow fibs first of all. Now, a pro advantage basically is a trade can often develop quickly to target. When the breakout does occur, price has the tendency to really accelerate and move fast towards that target. So that's something that's certainly an advantage there with trading shallow fibs. There are also certainly some very serious disadvantages. For instance, the fact that price is pretty far from a bottom or top. So, that makes a stop loss placement either very distant, because if you use this top all the way here, well, it's pretty far from the entry in a very sizable, space. Or very risky if one uses a tighter stop loss just above the fib, for instance. Well, then the distance is tighter, right? The stop loss is smaller, but the chance of price hitting that stop loss is just bigger, right? Let's face it, there is a 75% chance that price retraces deeper. So there's also a 75% chance that the stop loss will get hit. So that's not so good. So I'm, from that point of view, what is my battle plan? Well, I'm very cautious when trading shallow fibs because there is that chance of a deeper retracement. So most of the time I will not trade directly at those shallow fibs. Instead, I rather wait for price to bounce at those levels and either wait for price action at the fibs or even take a breakout as the breakout occurs. So want a bit more confirmation of price, indeed, respecting those levels. Now, how about, let's say, medium fibs? Well, those are first of all, the 15 to 61.8, and they account for a 40% total bounce. 40% of the time, price bounces at those fib levels, so they're quite important. Well, there are a lot of advantages with these fibs. I really like the medium fibs because there's that good reward to risk. There's stop loss is not too far away. It's not like the shallow fibs, very far away. So it's pretty tight. You got a good reward to risk, especially if you wait all the way for the minus 61.8 target or the minus 1000 target. You got a lot of space there. And obviously, there's already some shallow fibs that have been broken. There's only a couple of deeper fibs left. There's a decent chance that we'll use that midpoint or the golden ratio to make that bounce. So what could be a disadvantage? Well, sometimes price moves back to medium fibs with a lot of momentum. Like in this case, you can see actually there's sturdy downside candles being posted on the chart. And taking a trade against that momentum sometimes feels like catching a falling knife, as it's called. So that could be a bit, feel a bit dangerous or risky. That's I would say, one of the few disadvantages. Otherwise, it looks good. So what is my battle plan? Well, I like those medium fibs, and I'm willing to use pending orders in some cases when I see heavy chart confluence and judge the probability for bounce pretty high. Other times, I just wait for price action to confirm a bounce at those fibs, especially when momentum is developing quite quickly in the other direction. But yeah, in general, medium fibs offer good R2R, decent probabilities, and relatively quick trades. So I like those. How about the deeper fibs, like this one, for instance? This worked out fine. Well, we got great advantages at the small risk, as you can see. Just a very small red circle. Big blue circles means a lot of potential reward. Yes, that is true, but there are some disadvantages. Price has retraced already pretty far, a pretty big part of the previous price movement. There's just a high chance that a triangle chart pattern could occur, and that leads to indecision. And when a triangle does occur, it could mean that basically price is going to kind of get stuck in a big zone, a big consolidation zone. All right. So from that point of view, it's kind of like the trade could take very long to develop as well. The third thing is actually that there could be even a reversal, and it's good to check if the fib has actually value. Is it the good swing that we're using? If price goes that deep then we might want to be careful with that. So that's something to realize. You know, when you're looking at these deep fibs, yeah, they're good R2Rs, but sometimes they take long to develop. You can get a triangle, and sometimes you might get a reversal. So something to be worried about there. Sometimes take a look at these wonderful webinars of the FX Trading Festival. Make sure to join, and looking forward to see you on that list and in the webinar. Thanks so much, and good trading. Cheers.